Welcome to Finance News Frontier. If you look beneath the daily headlines of market volatility and tech sector earnings, you'll see a fundamental reconfiguration of global infrastructure happening right in front of us. In this explainer, we're taking a calm, analytical look at Amazon's massive $200 billion strategic pivot. We are going to move right past the hype to understand the hidden economic structures, the real incentives driving these decisions, and what long-term changes are actually forming as the intelligence economy scales up.
To understand a shift of this magnitude, we really need to look at it like an iceberg. So, here's our agenda. We'll start with the structural pivot itself, then look at integrating the entire AI stack. After that, we'll dive into the neutral platform advantage, navigating severe physical constraints, second-order ecosystem disruptions, and we'll wrap up by looking at some plausible scenarios for this AI supercycle.
Okay, let's jump right into Section 1, the structural pivot and the $200 billion bet.
$200 billion. That is Amazon's capital expenditure commitment for the 2026 fiscal year alone. To really put that into perspective, that figure far exceeds the annual budgets of most sovereign nations. It's an absolutely massive, calculated bet that fundamentally reconfigures their entire business model. What they're doing here is prioritizing infrastructure-led growth over near-term profit maximization. And the incentive is pretty clear, right? It's unserved demand. This capacity is monetized almost the second it's installed. But spending at this scale creates a really fascinating gap between the short-term market narrative and the long-term economic reality.
You probably saw the initial market reaction. People fixated on a dramatic compression in free cash flow, watching it drop from $38 billion in 2024 to roughly $11 billion in 2025. Naturally, that caused some immediate market volatility. But the structural reality tells a very different story. Look at the AWS Cloud backlog, which is essentially a pre-sold inventory of future revenue commitments. That backlog surged to $365 billion by mid-2026. So that backlog is the demand signal. It's what transforms a seemingly terrifying expense into a highly calculated industrial scaling project.
And it's absolutely crucial to remember that Amazon's capital allocation doesn't just exist in a vacuum. This is really just the leading edge of a broader, industry-wide AI infrastructure supercycle. As you can see, Alphabet and Microsoft are deploying similarly staggering amounts of capital. The competitive pressure out there is immense, basically forcing these hyperscalers to double their capital intensity just to maintain their market share. But Amazon's specific strategy for deploying all this capital reveals a very particular and very interesting logic.
Which brings us to Section 2, integrating the AI stack through vertical integration. Let's look at how they're controlling the underlying hardware.
The core strategy here is extreme vertical integration. Amazon is addressing the chronic shortage in high-density compute capacity by building a moat that is just as much physical as it is digital. They're moving away from simply being a software layer to owning the entire stack. We're talking everything from the proprietary 3-nanometer silicon chips rendering the calculations, to the massive data centers housing them, all the way up to the low Earth orbit satellites connecting them globally. Basically, Amazon wants to own the very pipes of the future economy.
The financial incentive for all this physical integration is probably clearest in their custom silicon program. By developing their proprietary Trainium 3 chips on a 3-nanometer process, AWS is strategically decoupling itself from really expensive third-party hardware dependencies. For their enterprise customers, this translates to a massive 30 to 40% price-performance improvement over comparable GPU setups. And for Amazon, it means capturing triple-digit growth in their custom chip business while saving tens of billions in capital costs. It's a win-win for their ecosystem.
Moving on to Section 3. The neutral platform advantage and commoditizing AI models.
This control over the physical infrastructure directly translates into their market positioning. You know, the old narrative of early cloud exclusivity has fundamentally dissolved. In a massive structural shift, Amazon formed a $50 billion strategic alliance with OpenAI. Let's break down the mechanics of this deal, because they are fascinating. First, AWS secures exclusive third-party distributor rights for OpenAI Frontier. Second, they are co-developing a stateful runtime on Amazon Bedrock, which essentially allows AI agents to maintain memory over long tasks. And third, OpenAI actually commits to consuming 2 gigawatts of Trainium-powered capacity.
What's really brilliant about this approach is that Amazon is essentially commoditizing the model layer. Through Amazon Bedrock, they're playing neutral host to Anthropic, Meta, Mistral, and now OpenAI. At the exact same time, they're offering their own cost-optimized Nova models, like Nova Premier for million-token reasoning and Nova Pro for multimodal workflows. For enterprise customers, this is the ultimate hedge against single-model obsolescence. You aren't locked into one AI lab's roadmap anymore. You can swap models seamlessly on a neutral platform, and Amazon captures the compute revenue underneath the whole shebang.
All right, Section 4, Navigating Severe Physical Constraints, Power, Land, and Steel.
We are moving out of the digital realm of software and into some very hard physical realities. The bottleneck for AI growth isn't really algorithmic anymore, it is structural. The industry has shifted away from isolated server halls and into gigawatt-scale ecosystems. Just look at some of these key 2026 expansion projects. Project Rainier, down in Indiana, that's a 2.4 gigawatt facility. The Mississippi complex is 1.5 gigawatts, and Matamine, Virginia is 0.77 gigawatts. These are the physical dimensions of the AI supercycle. We're talking about dedicated power substations and highly advanced thermal management just to keep the lights on.
And deploying compute at this scale creates an unavoidable energy imperative. Global data center electricity consumption is projected to double. So to navigate this, Amazon has essentially taken on the role of a de facto energy utility. They've made a ratepayer protection pledge to fully fund the energy infrastructure required for these facilities, including committing $300 million for regional grid upgrades in Mississippi alone. And beyond that, they are pioneering next-generation nuclear power, with investments in 960 megawatts of advanced small modular reactors just to guarantee their own supply chain.
To put that energy footprint into perspective, Amazon's renewable energy portfolio currently sits at over 40 gigawatts of capacity globally. That is literally enough to power 12 million American homes. What we are seeing here is big tech structurally intersecting with the global energy utility market. It is permanently blurring the lines between digital service providers and physical infrastructure operators.
Let's look at Section 5, Second-Order Ecosystem Disruptions, the Ripple Effects.
This blurring of lines naturally creates massive ripple effects in adjacent markets outside of traditional cloud computing. One of the most aggressive plays is in orbital connectivity. Previously known as Project Cooper, it was rebranded in late 2025 to Amazon Leo. This low Earth orbit satellite network is designed to provide a direct-to-device pathway for AI, completely bypassing traditional internet bottlenecks. However, we have to note that this carries severe execution risk. By April 2026, they had 302 satellites launched, but to meet FCC mandates, Amazon must have 1,618 satellites in orbit by July 2026. That requires an almost unprecedented, flawless launch cadence.
Back down on the ground, Amazon is applying the exact same AWS playbook to the physical world. Through Amazon Supply Chain Services, they are opening up their vast automated logistics network to third parties. By capturing market share in the $1.3 trillion logistics market, they are generating a high-margin revenue stream that actively helps offset the massive capital intensity of their AI build-out. So it becomes this highly integrated ecosystem where physical operations actually fund the digital expansion.
Finally, let's turn to Section 6, Scenarios for the AI Supercycle, Plausible Futures.
As analysts, we have to separate established facts from plausible futures. How might this all play out? Well, we have to maintain our restraint and look at competing interpretations. In a scenario of what we could call accelerated dominance, that $365 billion backlog efficiently converts to revenue, enterprise adoption of the Bedrock platform matures rapidly, and that massive infrastructure moat proves completely insurmountable for competitors. But we must also objectively consider capital strain. What if latency-sensitive enterprise AI fails to scale past simple tools? What if energy constraints hard-cap data center growth or the LEO satellite network misses its FCC deadlines? If monetization slows down before these $200 billion assets are fully utilized, the return on invested capital could suffer significantly.
Which leaves us with a critical, unresolved analytical tension. The sheer scale of this capital allocation is a historical fact, but the long-term durability of the economic model is still a scenario taking shape beneath the surface. So, the question we must ask as we watch this play out is this: does unprecedented scale in AI infrastructure guarantee a durable economic advantage, or will severe physical and energy constraints fundamentally reshape the economics of AI growth entirely? Think about that as these numbers continue to evolve. Thank you for joining us on Finance News Frontier.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.